A very good evening, everybody. Welcome to the webinar, Three Key Steps to Trading Global Indices. I'm Ming Hui from Phillip Futures, and speaking to us today will be professional trader Mr. Yong. And as the webinar title says, he will be sharing with us the three key steps you should take to trade global indices, and that includes understanding if the global macro environment is supportive of the global indices and more. Before I pass this on to Kayong, I'd just like to inform you that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box as we will have a Q&A session towards the end. And now, without further ado, let's have Kayong speak to us.
All right, just do a very quick check. I think you'll be able to hear my voice now as well as the webcam. Okay, so again, really excited for giving me this opportunity to share with you a little bit more about what I know in the financial market. Okay, and really excited to be able to have this chance to connect with you guys in the live webinar as well. Okay, so great. Today's topic is about the three key steps to trade the global indices. Okay, so I'll walk you through the entire webinar. What are some of the things that you want to pay attention to? Okay, and of course, we'll share with you throughout this webinar as well. At the end of it, what are some opportunities that you want to keep an eye on moving forward, at least for I would say the next 1 or 2 months time. Okay, but before we go into the content for today's sharing, I will do a very quick and short introduction about myself. Because I simply believe that if today I'm going to share with you some knowledge, I think it's important to know a little bit about me as well, your speaker today, right? So my name is Kayong. I've started my trading journey back in 2012 and started actively sharing in the public since 2015 until today. And of course, before that whole lockdown period, before 2020, we do a lot of physical sharing and events globally as well, mainly in Southeast Asia. And of course, since 2020 until today, we have been focusing a lot on online, right? Because of the lockdown and things like that. And I believe that it's also important to show you that, some of my results, okay, not to really kind of like compare or anything, but I think it's important that whatever I'm sharing with you comes from practical experience, okay, not really some just theory stuff that you can find online or from books, okay. What I'm going to share with you today in this webinar is really from my own personal experience, and of course, right, these are the things that I apply in my own trading and investing as well. Okay, so I actively trade the FX market, the Forex market, and I do also involve in invest and of course swing trade some of the stocks mainly in the US, right? So this is my 2019 FX portfolio result. Okay, of course 2019 right now is a bit far back. You can see that up and down, right? I'd like to be very transparent throughout this entire webinar as well. Hey, this is my result in 2020 for FX portfolio. You can see it's a bit tougher last year. Okay, there are of course a little bit more down months, but overall last year I managed to at least make about 8.5% from the FX portfolio. And this is the current year, right? Year to date, January and February. Okay, so that's so far what I have on the FX side. And in the stock market last year, I was able to make about 36.9%. Okay, and to date for 2021, I'm up about 7.31 in terms of the US stock market. Okay, so this is really just to share with you my journey. Okay, there are definitely losses and winners, and I think it's important that you also understand that whatever you're going to hear from me today comes from practical experience. Okay, so for those of you who would like to maybe connect with me further, okay, you'll be able to find me on social media platforms like Facebook and Instagram. Just make sure you type my full name because I think recently there are a lot of imposter account out there. Okay, just be cautious on that. Okay, so with that, let's get started with today's presentation. Okay, there are three objectives that I want you guys to take away from today. Number one, of course, we're going to talk about how you can kind of understand and figure out if the current global macro environment is supportive of the indices. Okay, and of course, when we talk about global indices, generally speaking, we are talking about equities market. Okay, just that we are not looking at individual stocks, but basket of them, right? So generally, when we talk about indices, you are also looking at equities market as a whole. Okay, so today you actually identify some of the methods of how you can know whether the global macro environment is supportive of global indices. And the second part of today's webinar, we're going to talk about how we can understand and look into whether the large speculators, and this one here we're talking about hedge funds, fund managers, people who are in the financial market to make money, we are able to understand whether they are buying or selling, and of course, how interested are they in this equities market, right? Global indices, we are talking about like US, Japan. We'll take a look at Singapore and of course some of the emerging markets indices as well. Okay, and last but not least, at the end of this webinar here, before we conclude, I'm going to share with you some strategy, okay, looking at technical charts on how you can time and execute your trades. Okay, so and of course, at the end of the day, all this information that you see, including the slide deck and all the chart templates that we're going to use on the MT5 Phillip Futures platform, you'll be able to download them at the very end of this webinar. Okay, and of course, I'm pretty sure throughout this, you definitely would have questions. Do write them down because as I'm presenting, I won't be able to monitor the questions. But at the end of this presentation, we'll have some Q&A segment. Hey, we do have time for questions and answers. That's where you'll be able to ask, and I'll try my very best to answer as many questions as we can in today's sharing. Okay, so first off, I think it's very important that if you want to trade the equities market, or even if you don't trade equities market, I think it's a very important knowledge to understand what we call the market fundamentals. Okay, and we are talking about global markets. Okay, so if today you are only trading the FX, you're actually just a small portion of the global market, or if today you're only trading stocks, okay, you're only a small portion of the entire global markets. Because if you take a look at all the financial instruments out there, it includes like bonds, stocks, indices, commodities, and of course currencies. Okay, and then within each of this asset, you have multiple ways to trade it. You can do like spot FX, you can do options, you can do futures, right? And of course, you can trade shares directly as well, and CFDs, right? So there are many ways, but I think first off, before we dive into the detail of it, the individuality of it, okay, it's very important that we look at the big picture. Okay, and we talk about market fundamentals here. At the end of the day, right, if I were to simplify the entire understanding of the financial market, it all boils down to demand and supply. Okay, and really there's not much of a secret here, I would say, once you understand this principle of demand and supply in the market. Okay, so everything really in the market comes down to just demand and supply, right? And in a very layman term, demand is how many people want it, that's demand. Okay, and supply is how many people are willing to sell it. Okay, and that's supply. Okay, but of course, that's the simplest way that I can say. Okay, but of course, let's dive into a little bit more technical details. Okay, so in the simplest form, right, I want you to know that the market, when we talk about market here, is the financial market. There are three major assets. Okay, and of course there are more than that if you break it down, like commodities are not here. Okay, but we just simplify it into these three simple assets, right? Stocks, bonds, and cash. Okay, so where do FX falls into? I think FX, you can just put it under the cash component. And of course, if you want to add commodities, by all means, okay, but usually when we talk about the market, these are the three assets, okay, the major ones. Okay, and you need to understand what drives the prices of this asset, right? And once you understand that these three assets, basically, I want you to be able to see that today, okay, if you are participating in the financial market, you're either into stocks, okay, if not, then you're into bonds, and if not, you're into cash, right? So there are only three options, okay, just see it that way, right? And commodities, you just slot it in, okay? So the driver of all this asset selection, right? So if today you come into the market and I ask you to choose one, okay, you have some cash allocated, right? So where would you put this cash? Okay, will you hold it as cash, okay, or will you put it into bonds, or will you put it into stocks? Okay, so you need to also then understand what drive the asset selection, what helps you to make the decision as to where you want to allocate. Okay, and at the bottom line, there's only two things that drive the asset selection. One is price appreciation. Basically, you know, over here, you probably hear of this term here called FOMO, right? Fear of missing out. Okay, so it's actually related to price appreciation. If something is rallying all the time, then what will you be? You'll be feeling that, oh, I'm missing out, right? And then what will happen is that you want a piece of it. Okay, so price appreciation actually drives asset selection. Okay, that contributes to where you want to put your money, okay, where you want to put your capital. The second one, okay, is risk appetite, which means that how much are you willing to take in terms of the risk, okay? So if today we talk about some asset, right? Today, I think the most popular news right now, yesterday and today, will be like cryptocurrency, Bitcoin. But though we're not talking about it, I'll use that example, okay? It hit like close to 58,000, right? And what is the general retail consensus is that we are kind of like, we want a piece of it, right? It's going so up, so high, so fast, we want a piece of it, okay? So what is driving that is price appreciation, okay? But why do you think majority of fund managers are not jumping into this bandwagon yet? It's because of risk appetite, right? We understand that Bitcoin or cryptocurrency, in fact, is a very volatile asset, and therefore they need to manage their risk, okay? And the risk appetite is actually holding them back, okay? So I want you to understand that at the end of the day, right, even for yourself as a retail trader or investor, when you are actually choosing what to go into or where to allocate your capital, fundamentally, these are the two drivers, okay? Price appreciation, risk appetite. Okay, and when we talk about demand and supply, right, where does it come into the entire equation? Okay, I want you to understand on the demand side first, okay? Essentially, what constitutes demand in the financial market is basically the amount of cash available, okay? Because today, if you want to buy stocks, you want to trade indices, you want to trade FX, you need what? You need capital, and capital comes in the form of cash, okay? So the bigger the amount of cash available, the higher the demand can be, right? So that is where it comes from. And of course, the second one here is we are talking about risk appetite. Okay, so if today you are someone very greedy, right, but you do not have cash on hand, what will you do? You leverage, right? So you actually go and borrow, you use leverage to get involved into the market. That also constitute to demand. Okay, and on the supply side, essentially, if you are talking about the stock market, is your market cap. Okay, and the interesting thing about this is that it's essentially unlimited in a way, because market cap is basically shares outstanding, how many shares are available in the market, and price. Okay, and we know that the shares outstanding is kind of like limited unless the company release more shares, but price is unlimited. Okay, so in the equation, if you just take shares outstanding times price, price is unlimited. Okay, so stocks at the supply side again is unlimited in a way. Okay, and the other asset here involved in the financial market is your bond. Okay, and bond is limited because bond is issued by your central bank and governments, right? So that is limited. Okay, so if you put this into the equation, right, that's where you can kind of like understand the big picture, okay, where demand is coming, where supply is coming. Okay, and on the demand side, okay, I want you to know, and this is general knowledge as well, okay, that right now the whole financial system, the monetary system that we're in, is actually what we call an inflationary system. Okay, an inflationary system is basically means that the central banks, when they need to, they're just going to print more money. Okay, and there is no cap, right? Because they are the central bank, they can decide how much they want to print. And what you realize that if you just look back all the way from the Great Depression until today, the banks has always been printing. Okay, so we are in a system where the quantity of the money is always increasing. Okay, yes, there is rise and fall of, you know, who is controlling the global currency, but at the same time, I want you to understand that we are generally in this system where money is always increasing in quantity. Okay, and if you take a look at the US itself, okay, so right now US dollar is still the global reserve currency, so we'll look at the US, right? Over the past 50 years, right, the money supply in the US has gone up by an average of an annual rate of 8% per year. Okay, which means that every year, okay, if you average it out, okay, the US dollar itself has increased its supply by 8% a year. Now, this is even more crazy because last year itself, because of COVID, okay, the whole dollar supply increased by 20%. Okay, in 1 year, right? So that's how scary it is when you put that into perspective, how money has already increased in terms of the quantity. Okay, so last year alone is a 20% increment. Okay, so understand the demand side. demand side, right? Money itself, cash itself is demand. Okay, and what we have experienced near term last year is that there's a huge increase in cash. Okay, and what will happen is that eventually this cash will come back into the financial market. Okay, whether you like it or not. Okay, and if you take a look at what's happening, like those GameStop, meme stock, okay, Wall Street bets, that's all the retail pumping money into the stock market. Okay, so that's the demand side. Now on the supply side, okay, it's where you're looking at stocks. That's where your companies come in, your shares come in. Okay, and we know that in the US, okay, so this is uniquely in the US, they are often doing what we call share buyback. Okay, this is very common in the US. And what they do is that if you go and look at the statistics, there's an average annual return rate, okay, of 2%. It means they always cut and buy back shares by a rate of 2%. Okay, so think of it as the supply is being reduced, okay, every year reduced by 2%. Well, at the same time, money is being printed on an average of 8%. Okay, so demand is increasing, but supply is coming down. What will happen if you are understanding a little bit of economics, right? Demand increase, supply drop. What happened to price? Price will go up, okay? So that's the reason why if you actually take a look at this equation, okay, demand increasing by 8%, supply drop by 2%. If you net it off, that's a disparity of 10%. Okay, and that itself, if you put that into, okay, the average return of the S&P 500, what do you get? Okay, the annual average return of S&P is about 9.5 to 10%. Okay, so where does this come from? It really comes back down to the whole equation of demand and supply. Because money has been increasing by 8% on average, the supply has been dropping by 2% on average. If you put them together, that's where you get about 10% annual return on the S&P. Okay, so if you understand that, right, we are in an inflationary system. Okay, and we are looking at companies continuously going to buy back shares. Then you know that what's going to move the market. Okay, this one here I'm going to quote Stanley Druckenmiller. Okay, what is going to move the market essentially is money. Okay, and of course he uses big term here like liquidity. Okay, but at the end of the day, it's really about money. Okay, and what he meant over here by liquidity is how easy the money is flowing. Okay, and that's basically cash, right? If you take a look at 2020 March last year, what happened is that the Federal Reserve print a lot of money and then they push it out to the economy, right? And where does the money goes? The money eventually goes back to the stock market, and that's why you see a very strong recovery in the S&P and of course the global stock market as well. Okay, so understand this equation, understand the big picture. Now, if you take a look at that and you understand this, right, you know that if today you want to solely focus on global indices, or in short, stock market as a whole, okay, I'm not talking about the individual company stock, we are talking about global country stock indices, okay. Generally, if you're looking at them, then the path of least resistance, I always say, is always up, okay. Yes, there are certain times where the indices or the stock market is going to do its correction, or sometimes it might have a much bigger correction and we call it a crash. But if you take a look at where it started, it's always going up. Okay, and this is the reason why, is because we are in an inflationary monetary system. Okay, and the demand and supply equation just stack up, right? So if you understand that, and today you want to trade global indices, right, the direction that you want to always focus on is the upside. Okay, of course, in the short term, you'll be able to short it to profit from the correction, from the mini crash. But if you pull your horizon long enough, okay, the focus on the direction is going to be always up. Okay, and today I want you to focus on just up. Okay, because if today you want to short it, that's where a little bit of experience come in. Okay, you need to probably have some strategies to kind of short the indices, and of course you need to have some experience in the market to do that. But if today you're very new, just focus on buy opportunity in the indices, okay, because that's where path of least resistance is going to be. Okay, but next question you generally would have is that, okay, now you understand the equation of the big picture, the global macro, which is demand and supply, and you understand that generally if you stretch out your horizon long enough, the direction is definitely up. The next question naturally is when, right? So if it's up, when would I buy it? When is a good time to buy into it? Okay, so this is the part where I want to share with you using what we call COT report. Okay, the full name here is of course Commitment of Traders Report. We are able to track the big boys. We call it the big boys, but essentially they are just your hedge funds, your traders who are in the market for profits. Okay, so they are not in the market to hedge. Okay, some banks, some companies does that, but when we are talking about big boys here, we are referring to people who are in the market, okay, who is large enough with the intention to profit from it. Okay, we as retail, we are not considered that, right? We are not big boys. We are just non-reportable. So we are talking about big boys here. We are talking about people who are large enough. Usually this is where your hedge fund comes in, right? Your fund managers and things like that. So COT report, for those of you who are very new, okay, this is perhaps the first time you hear about it, then I'll quickly introduce you briefly what it is. Okay, so this report here is actually freely available online. Okay, the only thing is, of course, you need to have some, you need to know how to extract the information out. Okay, but this is a weekly report issued by Commodity Futures Trading Commission, okay, which is in the US. And what this report tracks is the futures market. Okay, so if today you are trading spot FX, you won't be able to find the information. But since today we are talking about global indices, right? Some of these indices have futures in it, right? You have your mini S&P futures, you have your NASDAQ futures, you have your Dow Jones futures as well. Okay, so we are able to track as long as that asset has a futures. And why we are able to track the big boys buying and selling activity is because futures is a centralized market. Okay, your spot FX is not, therefore it's very difficult to track. Okay, so futures market is centralized. You are able to track the activity of buying and selling, right? And over here, okay, what we want to do is we as retail trader, we want to understand how many of these big boys are interested in that particular asset. Is it very high in interest or they are totally not interested in it? Okay, and the next thing we can track is how many of them are buying, how many of them are selling. Okay, so if you actually have this piece of data, right, it becomes when you want to trade, it helps you in your conviction. Because if today nobody is interested in asset, why would you go and trade it? Okay, there are nobody in there, right? Don't go there. If today there are a lot of interest in this asset, then your attention should be there. Okay, then the next step is, are they buying or are they selling? And generally, as a retail, you want to follow what the big boys are doing because, okay, they are called the big boys. They are there because of, you know, whatever reason they are, right? Either they are experienced, they have certain knowledge, they have certain information that can position themselves in that trade. Okay, so certain things we might not have access to, they might have it. Okay, so understanding the COT report gives us that kind of insights as well. Okay, so over here, if today you're very new to it, there are some key terminologies that you need to know. The first one here is what we call open interest. Okay, I see one of you actually says you lost the audio, but I think should be fine. Okay, maybe if you want, just check a little bit. Okay, yeah, so I think the audio is good, right? Oh, you guys can hear. Okay, so we're talking about just now in the COT report, there are few things you want to check. Okay, so over here, there are few terminologies. I'll introduce you to them so that you understand. Okay, and I don't want to overcomplicate it, right? In this webinar, we're going to make it simple and at the same time, very, very applicable. Okay, so the first thing I want you to know is this thing called open interest. In short, we call it OI. Okay, so open interest is basically just like the total number of contracts in the market. In other words, how many people are involved in the market. Okay, so that's really what it means. Okay, so if the open interest number is increasing, it means that more people are interested in it. Okay, and of course, vice versa, right? Falling OI means that it's less interested. It doesn't really tell you the direction. It's just telling you how much interest there is. Okay, so for example, if we, you know, let's say in this room here, I think today we have about 90 plus people in the room, right? So give you a context and example. Okay, and I say, okay, today, how many of you are Apple fans, right? iPhone fans, okay? And let's say 60% of you are Apple fans, right? Then what happens over here in open interest is that 60% of you are interested, okay? And then That's what it basically just means. It doesn't mean that you would want to buy it or you want to sell it. It's just interest, okay? So higher OI means people are looking at it. Lower OI means people are not bothered with it, okay? So that's the logic behind it, okay? And of course, the next one here is pretty straightforward. It's just long and short position, okay? Long means buying position, short means selling position, okay? So long and short really not that crucial, but you need the long and short to get the net position, okay? And net position is just basically a summation of long and short, okay? So you would have a positive net position if you have more people buying, and if there are more people selling, then what happens is your net position is going to be in the negative number, okay? So by just looking at net position, you know very quickly, are there more people buying or more people selling? Okay, so this is again centralized, and we are looking at the futures market. So every transaction is being recorded. Okay, so I want you to know that. And over here, just now I mentioned that positive means more buying, negative means more selling. Okay, so these are the first two information that's crucial: open interest, net position. Okay, and the third one here that we track, okay, is what we call COT index. Okay, now the formula of index, I think you can find out if you are someone who study math, you understand the concept of index. But if you are someone, you know, like me, I don't study math. Okay, so I'll try to break it down in a very layman way of understanding what an index is. Okay, essentially, as I put here in a PowerPoint, right, it's a comparative analysis of historical high and low. Okay, so for example, okay, in COT, we always use a historical data of up to 3 years. Okay, so if today is like beginning of 2021, then 3 years historical data is like 2020, 2019, and 2018. Okay, so between 2018 to 2020, that's 3 years. Okay, we want to know within this period, within 2018 and 2020, what is the lowest and what is the highest net position. Okay, so within the past 3 years, we take the lowest net position and the highest net position. Okay, and that becomes our comparative basis. Okay, and what we're going to do is moving forward in 2021, we're just going to compare current net position against the lowest and the highest in the past 3 years. Okay, that's essentially what it means. I hope you guys understand. Okay, so index here ranges from 0 to 100. Okay, because you're comparing to historical high and low, you need to have a basis, right? So the lowest is going to be 0, the highest is going to be 100. Okay, so the idea here is just like I mentioned, right? Based on past 3 years, the lowest net position is going to put it at 0. Okay, so give you an example, right? If let's say from 2018 to 2020, the lowest net position is, let's say, negative 10. Okay, so negative 10 net position will be put into the index as 0. Okay, and of course the highest will be based on 100. Let's say the highest net position was 10 in the past 3 years, right? Keep it very simple. Lowest is negative 10, highest net position is 10. So the index here, net position negative 10 becomes 0, net position 10 becomes 100. Okay, so if today the net position is 0, where would your index be? It's the halfway point, right? So your index will gonna be 50. Okay, so that's the idea behind it. Okay, I think okay, it's important to understand, but if you have no idea or you have totally lost what I've been talking about for the past 2 minutes, okay, perfectly fine. Just see it, the COT index as 0 and 100 as extreme zone. Okay, so what happens when we are in extreme? Likely there will be a reversal. Okay, so if you have no idea just now what I'm talking about it, just understand 0 and 100 is extreme. When we are extreme zone, likely there will be a reversal. Okay, so that is how we use it. Okay, so we want to just know that today's net position in relation to historical high and low, where are we? Are we at extreme? Okay, that's all we need to know in terms of COT index. Okay, so now if I put all this together and we start to use the COT data, okay, which I show you, I've done all the extraction for you guys in terms of the global indices. Okay, we want to know whether there's an interest in an asset, right? Just like I mentioned, if people are not interested in it, then why you want to go in? Okay, you want to be together with the big boys. Okay, if there's an interest in it, pay attention. If there's none, don't bother. Okay. The next thing is, after you identify there's a key interest in this particular index, the next thing is you want to know, are there people buying or are there people selling? Are there more buying or more selling? okay, and you want to follow the majority in this way, okay. And after that, you want to then also understand, are we in an extreme zone? Because again, if it's an extreme, means people who wants to buy has already bought it, okay. Why will you be the last person who go in and then when everyone has went in like way long ago, right? Okay, this is where, you know, sometimes you might hear people say like, you do not want to be the last sucker to be in the market. Okay, so that's the idea of it, right? When we track COT index, is it an extreme? Okay, you want to take note of that. Okay, so when you know this three pieces of information, you'll be able to position yourself better as to whether you want to get in now or you want to be patient. Okay, so again, today we'll only be focusing on buying opportunity because just now we talked about how the indices are generally up, right? So we only want to focus on buy. That's our direction for today. Okay, and subsequently over here we're going to share is more of like when to get into a buy. Okay, so the idea here is that let me share with you some of the extracted COT. Okay, again, all this data on the COT is actually available online. Okay, you actually just need to type in Google like COT report. Okay, and the first result on Google is the official website that you can download all this data. Okay, but of course over here, this screenshot that you see is an Excel spreadsheet that I kind of like put in the data to make it a little bit nicer, you know, reorganize it a little bit, have some color coding. That's about it. Okay, there's nothing extra coming from it. Every data here is being extracted from the official COT website. Okay, so the first one here to give you an idea of how to apply this, okay, and what is the current environment or current context of the COT. Okay, this is, let me bring in my pen. Okay, this is the S&P 500. Okay, and this is of the latest data we can get, 16th of February 2021. Okay, so it's the weekly report. So you realize that every data is about one week, right? About 7 days in difference. Okay, so the latest one that we can actually get it from the website is 16th of February. Okay, and you can see this is the open interest, okay, which we talk about it, right? OI. Okay, so you want to see, is the open interest increasing or is the open interest falling? Okay, because if it's increasing means more people are getting into the S&P. If it's falling means more people are getting out. Okay, so it doesn't tell you direction, it just tells you the interest. Okay, so very quickly, if we put that analysis into the current one, you can see it's actually increasing, right? From 25,000, it has come to somewhere around no, it's 202.6. Okay, is okay, there are a few numbers here, right? But basically you get the idea. Okay, it's increasing. Okay, so you want to know that first off, open interest on the S&P is increasing, means large speculators, the big boys, are interested in this market. Okay, next you can see is long position, short position. Okay, usually I don't really pay too much attention to that, but more important here is your net. Okay, now can you see your net position is dropping? Okay, that means it's getting more and more negative, right? From somewhere around negative 17,000, it has now close to negative 80,000 as of the latest data. Okay, so what this means is that while the interest is increasing, people are getting in. You want to understand, are they getting in to sell it or are they getting in to buy it? Okay, and what you realize over here is while OI is increasing, net is falling, which means that people are getting in to sell it. Okay, and of course you can also see over here your short position from somewhere around 377,000, okay, to 426,000 of short. So the short position has been increasing. Now, once you just based on this information, right, what you realize is that, okay, the big boys are coming into the S&P, they're looking to sell it. And if today you are looking to buy, then please don't go and buy it first, okay? Because why would you buy when the large big boys are selling? It makes total no sense, okay? So that's how COT is able to give you that insight, okay? And over here, you can see this is, okay, over here you can see this is the index, okay, and the index right now is 39. Okay, what this means is that right now it's not at the extreme yet, because based on the past 3 years, negative 80,000 of net position is somewhere around like 40% mark, right? So it's not like extreme. Extreme here is like below 15, or above 85, right? So 0 and 100, you take 15 from 0, 15 from 100, that is your extreme. Okay, which means there's still room for it to move around. Okay, so that's the idea of the index. Okay, so basically you just want to know whether we are in an extreme. Okay, so from here I want you to see, right, S&P 500, the first indices that I think very popular. Okay, you want to know majority of these large speculators, they are selling. So don't go and buy S&P right now. Okay, we'll look at the chart later on to give you more insight. Okay, but this is from COT perspective. Okay, next up we are looking at Nasdaq. Okay, which is your, of course, Nasdaq 100. Okay, so same thing. Okay, same process. You can see OI, is it increasing or falling? It's actually increasing, right? From somewhere around 220, it has increased to 235. Okay, so people are getting interested in it. Okay, take a look at net position. It's positive, but from the highest peak of close to 40,000, it has dropped to 21,000. Okay, which means that while the interests are coming in, okay, there is a shift from buying to selling. Okay, but the overall net, okay, the overall net is still positive, which means overall there are still more people buying the Nasdaq than selling. But moving forward, there are more people coming in to sell. Okay, so I hope you can understand that whole thought process, right? Just from this data, you can see what's happening. And if you take a look at the index, it's red in color because it's already at extreme. Okay, it's already very close to 100, right? So what it means, likely there will be a reversal soon, which means people who wants to buy has probably got in already. Okay, and what's going to happen here is likely your net position is going to keep dropping. Okay, it's a reversal. Okay, so again, if you understand all this, you know a little bit of the timing factor, right? So you wouldn't want to jump in and buy Nasdaq right now because the big boys are transiting towards sell. Why would you go and buy it? Okay, so take note of that, right? So again, this is the next index for you to consider and take note of. Okay, Nasdaq. Okay, next one here is Russell, which is your US small caps. Okay, and again, very interesting data over here. Okay, first off, OI is increasing. Okay, which means more people are interested to it. But at the same time, can you see how the net has been from positive at the beginning of the year, and right now is actually in the negative territory? Okay, which means right now you have more sellers than buyers, right? At the start of the year, there are a lot of people buying the Russell. Right now, there are more people selling it. Okay, so again, with this, you can understand a bit more, right? But I wouldn't encourage you to go and trade the Russell, right? It's small cap, okay? And as a retail, don't go and touch all this. Touch something that is more popular, like S&P, Nasdaq. Okay, those are better instruments, indices that you want to focus and trade on. Okay, but I want to talk about Russell here, and of course, we also talk about emerging markets. Okay, I think it's important to understand it, but you won't be able to trade it as a retail. Okay, because you might not have access to all these instruments. Okay, but understand it because we talk about how money flows from one asset to another, right? Later part I'll share with you that principle. So you want to first understand where is the interest, where is money going to. Okay, so again, you look at the emerging markets indices, you can see where it's playing out, right? The OI right now is pretty much flat. Okay, so there's not much of a change. If you take a look at the net, more or less is about flat as well, right? It increased a little bit and then it came back down and then it increased a little bit. Okay, so it's basically flat. Right? What are emerging markets? Emerging markets are basically markets out of your developed countries. Okay, so for example, you know, in Latin America, one of the most popular one is like Mexico, Brazil. Okay, they are emerging markets. Of course, if you're looking at Southeast Asia, okay, Vietnam, those are your emerging markets. Okay, so it's a basket of various countries indices. Okay, so this is what we call the emerging market index. Okay, if you take a look at, you know, from a big picture perspective, right, you just want to compare like, okay, emerging markets are kind of like developing countries. Okay, and the US stock market are basically your developed countries. Okay, and depending again, right, you still remember the driver here is what drive demand is price appreciation. Okay, so depending on which one is performing better, that's where the money is going to flow. Okay, because that is going to drive money. Okay, that's going to drive demand, right? That's why we talk about it at the start. Okay, so right now from COT perspective, emerging markets are basically flat. Okay, So not much of it changes in it, okay? But overall net is positive, which means a lot of people are buying into the emerging markets, okay? Nikkei, which is Southeast Asia, kind of like developed markets, okay? Japan, same thing over here. You can see OI increasing, okay? Net position is dropping a little bit, okay? But it's still positive, okay? So quickly you'll be able to understand that, okay? Now this is where I want to share with you the concept of money flow, okay? Why, while we might not trade emerging markets, we might not trade you know, like Russell, but why is it important to understand, is there a demand in there? Because of the concept of money flow, okay? And again, we talk about demand that's going to move prices in the market. So cash or money is basically demand, and demand will go where prices increase, okay? So when there's higher demand coming in, that asset price will naturally increase, okay? So the idea is we want to know where the demand is going into, okay? If the demand is getting out from the US, then naturally your US stock market will drop, okay? If demand is coming back to the US, then US stock market will rally, okay? So that's the idea of why we want to understand where the money is flowing into, okay? And over here, okay, once you know that, okay, the next question is where, okay? So from the COT perspective, you know, kind of like understand that the S&P is not something you want to touch right now. The NASDAQ is not something you want to touch right now, okay? And based on that right now, emerging market is the one that is actually having a pretty kind of like sustained buying interest, right? Even the Russell is dropping, okay? The NASDAQ is also starting to fall. Emerging markets is the one that is still sustaining it, and of course Nikkei is also starting to drop, right? From 17,000 it drops to close to 13,000, okay? So that's also part of why you actually start to witness from Monday, yesterday, okay, the market has started to come down a little bit, okay, because money is actually getting out of all this equities market, okay? So far so good, okay? Yeah, so if you have any questions, feel free to put it in the comment section, or you know, type it in, okay? But last part that I want to go through, then we'll open up for Q&A, right? So once you understand all this, this is where your technical charts come in, okay? Understanding where to get involved, right? Which price to get involved in, okay? And in terms of technical chart over here, okay, the strength of it, right, as I mentioned, right, you can identify like exact prices that you want to execute a trade. You know where to focus on, okay, and you know when you are wrong and get out of it, right? Basically your stop loss, okay? So over here, because we are focusing on, again, buying opportunity from the global indices point of view, right, we are only wanting to buy it, okay? So I will share with you two patterns that you want to kind of like learn or memorize by end of today, okay? First pattern looks like that, okay? Of course, it can come in various scale or sizes, but more or less it looks something like this, okay? If you're familiar with technical patterns, this is basically a flag, okay? So be familiar with this pattern, okay? And another pattern here is this pattern, okay? This is what we call a diagonal, or you can just call it a crawl, okay? I like to just call it a crawl. Basically, it starts to come down, but it's lacking the momentum, okay? So just recognize these two patterns, okay? It might come in different sizes, but recognize it, okay? So how to trade it is basically very simple. If you kind of see this pattern here, a flag, okay, what you're gonna happen is you're gonna put your buy at the break of the top of the flag, and of course your stop loss will be just the bottom, okay? Don't look down on such simple technical pattern, because if you go into the charts, okay, this pattern tends to repeat itself over and over and over again. And what I realized is too many traders kind of like overcomplicate their whole process, and at the end of the day, they still don't see the result that they want, okay? So just keep it simple, okay, but don't look down on this simple patterns, okay? So this is what you expect it to go, okay? You should want it to break out and go fast. Okay, later I'll show you some of the patterns in the chart, right, that's happened. Okay, this one here as well, right? So how to enter, execute it at the break of the diagonal, okay, of the crawl, and your stop, you just place it at the bottom, and this is how it happens usually. You want it to go fast, okay? So understand this, okay, and let me bring you, okay, to the MT4 platform, okay, and walk you through the technical charts of some of these indices that we talk about, okay? What I've done over here is I've put in all my analysis and I've saved it up into a MT5 template, Okay, so by the end of this webinar, you'll be able to download all this template as well. And all you have to do is just, download Philip Futures MT5 platform, okay, and just load the template up, and then you'll be able to see the exact drawings that I have over here for you guys. Okay, what I've put in here is, of course, some areas that you want to keep an eye on, and then at the same time, I've put in some key levels where I'll walk you through why those levels are there. Okay, so first off, let's take a look at S&P 500. Okay, so this is the S&P 500 chart. Okay, on the 4-hour, and of course this is the daily. Okay, now first off, just now we have understood the COT perspective, right? So we are only interested in buy, but the COT tells us that S&P 500 right now you do not want to buy. Okay, at this very moment you do not want to buy. Okay, and from the chart perspective, that's where we come in and say, okay, then where would be the next level that I want to keep an eye on for potential buy? Okay, obviously it's not gonna be here. Okay, you do not want to buy now because COT is telling you don't buy now. Okay, but the next level, maybe as we progress next week, following week, the COT data might transit into, okay, now the big boys are buying, I want to get involved in it. Right, so this area here for the S&P 500, you want to keep a close watch on around the FIT 50 and 618 retracement. Okay, that's somewhere around 3,008 and 3,780. Okay, so keep an eye on that. Again, all this analysis are already done for you. Okay, you can load up the exact thing on your MT5 platform after this webinar when you download it. Okay, of course, this is the crucial level 3664. Okay, this is a crucial key level. As long as price remains above this zone, you're good. Okay, but okay, over here, if price actually breaks through the 3664, the next key zone that it can likely go is 3510. Okay, and if 3510 is broken, we are technically in a market crash. Okay, so yeah, so that is where I wanted to show you the extent of it. Okay, this is where March last year was. Okay, so if this scale here breaks below this level, okay, we are technically in a major crash. Okay, but at the end of the day, indices are always up. Okay, it will bounce back up. Okay, the idea is, again, do not try and catch the very bottom. Okay, use your COT, position yourself in there. Okay, so right now, do not enter anything on S&P. Okay, so that's the verdict. Next up over here, of course, is on Dow Jones. Okay, now Dow Jones, DJI, right? So ticker symbol here is US30. We do not have the COT. Okay, but from a technical point of view, can you recognize this pattern that we talked about just now, right? This pattern. Okay, so we talked about it just now. Recognize this because it tends to repeat itself over and over and over again. Okay, so the potential zone that you want to keep an eye on is, of course, around here. I think this is a bit smaller, 31193. Okay, so that's the area of Dow Jones, 31193, and of course the area here, the bottom one, is around 30897. Okay, so if I round out a bit, 30900. Okay, 30900. Okay, that's where you want to keep an eye on. Okay, of course, today we don't have the time to go into like details of to how you can actually buy. Some of you who are a little bit more experienced, you might look into like candlestick pattern, things like that. Okay, today I'm giving you some reference as to where you want to keep an eye on in the price level. Okay, so do take note of that. I think from here, this is Dow Jones. Okay, it shouldn't break 29653. Okay, if it breaks this level here, again, we're in the market crash. Okay, so keep an eye on that. Nasdaq 100. Okay, this is where I think technology stocks as well will see a major correction. Okay, so there's a very high possibility that Nasdaq 100 will come down towards 11503. Okay, again, this pattern here, of course, today we don't have time to really go into all these technical charts. Okay, but this is basically telling me a sell indication. Okay, and of course, if you're looking at indices, you do not want to sell it. If today you're very new, just focus on buy setup. Okay, so we do have a setup right now, obviously. Okay, so don't get involved in the buy. But I just want to share with you that right now, I think at least for the next maybe about 1 month or so, okay, at least for the March period this year, I think globally the markets are gonna do a correction. Okay, so just be cautious on it. Yeah, so we are seeing all this falling. Okay, so I think if you're looking to buy, okay, focus for Nasdaq. Okay, focus on this key level 11503. Okay, because there's a likelihood this can keep coming down. This is the area that you might potentially see a bounce. Okay, all these key levels that I put in, right, they are basically levels that you might see a bounce, so you want to keep an eye on it. Okay, so this is on Nasdaq. Okay, next up, Hong Kong as well. Okay, I think of all the indices, right, I think Hong Kong market is one of the market, which is Hang Seng, HSI, right, is one of the market that you want to really focus on, pay attention to it. Okay, because of all the indices, I think Hang Seng has the highest potential for you to buy for the upside. Okay, not specifically China, but Hong Kong. Okay, this is something I want you to know as well. Okay, China, I would suggest don't trade it. Okay, so this is Hong Kong. You can see that we are in kind of like a recent all-time high. Okay, the area that you want to focus on here is around 30,000 to 29,300 level. Okay, 30,000 to 29,300 level. As long as it's above 28,049, we are in an upside. Okay, so again, you can keep an eye on that. Again, this pattern here, I think we talk about it, right? I want you to kind of like learn and memorize this pattern. Okay, every time you see this, there's a high possibility it will go up. Okay, this pattern repeats itself over and over again. You just go through any of the charts, okay, you see it repeating itself. Okay, next up here is CM50, which is your China index. Okay, don't touch it. Okay, I think you know, it's just not worth the risk. Okay, anyway, you can see the momentum is to the downside. Just ignore, right? Anyway, I have the key level here for you guys as well. 18011. Very high chance price will keep falling and touch this level. Once this break, okay, it's gonna be huge move to the downside. Okay, there's a high chance if this level break, it's gonna go towards 15000. Okay, 15,000. Okay, but anyway, just don't touch it. Okay. Next is your STI, right? So for those of you who are in Singapore, this is your Straits Time Index. I think short-term wise, we are gonna look out for 325. Okay, again, I think for me, right, personally, I don't focus in Singapore market or even Malaysia market. Okay, I don't focus on this too because I think most of this opportunity will come from the US side. Okay, so that's my own personal choice, but I think some of you are still interested in local shares like Singapore and Malaysia. And of course, it's a bit close to heart, okay, and things that you can really see, right? And I know people who are making good money from it as well, okay, but it's just my personal choice. I think opportunities are readily available in the US. There are more choices in the US as compared to like Singapore or Malaysia. Okay, so if you're looking at STI Straits Times Index, I think from a charting point of view, okay, there's a high possibility this can drop and come towards 325. If this level break, we kind of see more towards the downside. Okay, and this is the pattern that you see. Okay, again, this is just the flip side of it, right? If you see a flag like looks like that, you know probabilities to the downside. Okay, on the higher time frame on the daily, you can see if this level break 325 break, the next one is 317. If 317 breaks, it's probably going to come down all the way until this area here around 290. Okay, so again, what we are looking at right now is a lot of all these indices are likely in a correction. Okay, market doesn't go all the way up, right? It's up and down, up and down. So all these indices are telling us that slightly coming down. Okay, this is German DAX. German DAX is interesting to keep an eye on because right now, as we are talking, price is already in this zone. So as long as price actually kind of like respect this area, right? So you can see the candle here. As long as price respect this level, I think there are upside opportunity on the German DAX. Okay, so keep an eye on it. Okay, as long as price is above 13002, okay, we are in the upside. But of course, I think if that level breaks, okay, this level here that we talked about just now, it breaks, then the next zone is going to come down to 13002. Okay, so your next buy opportunity is somewhere around 13002. Okay, so all these key levels that I draw in, they are actually your potential buy areas. Okay, that's what it means. Okay, FTSE as well over here. Okay, you can see this is 6241. Okay, that's the area that you want to keep an eye for FTSE. Okay, this is in the UK. Okay, that's where your buy potential comes in. Okay, and Nikkei as well, right? This is Nikkei. On the 1 hour time frame, this is where it is. Okay, let me put that in. Okay, 29490. Okay, you want to keep an eye on that. That's where your potential buy setup is coming in. Okay, so from the chart itself, you realize that many of these indices are telling us that short term it can still come down, right? So be patient. Do not jump into the trade immediately, but I think it's good because then it gives you time to prepare yourself. Okay, at least after today's sharing, you have ample time to kind of digest what we talk about. Okay, practice it onto your chart, put all this onto your chart, go and understand a little bit more about global indices, global market money flow, understand COT. Okay, so you have that time to do it because all this still needs time for it to eventually come down a little bit, right? So it's good because when we talk about it right now, you do have that time to prepare yourself for the opportunity, okay, when it comes. Okay, next, last part here on charting to talk about it is I just want to share with you this chart here where just basically comparing the US market, which I use SPY, S&P, versus the emerging markets. Okay, and this chart is basically a ratio. Okay, let me just change that to a line chart. Okay, and basically it's just a ratio of S&P divided by emerging markets. Okay, and if let's say you are seeing this coming down, what it means is that emerging markets are relatively stronger than the US. Okay, and that's what it basically means, right? And if you take a look at the COT point of view, that's what it's telling us. Okay, large speculators are into emerging markets and you know, shorting the US, right? And that's where we see this chart moving down. Okay, but why I want you to pay attention to this as well, okay, is because we are potentially seeing a U-turn. Okay, and I've been sharing with some of our traders as well, and I say that you want to keep an eye on the US market because what I'm seeing over here is that money has already been flowing into emerging markets since last year. Okay, and eventually when the emerging markets kind of exhausted its whole move, okay, that's where, guess where the money is going to come to. Okay, the money is going to go back towards the US, and that's where your opportunity in the US equity markets, your US indices, is going to come in. Okay, so if you take a look at this chart here, basically you want to pay attention. If this starts to break up, okay, out of this zone, okay, that's where you would see money starts to flow back into the US market, and that's where your US indices, your US stock market will start to rally. Okay, and that's where your opportunity is. Okay, so again, we talk when you are trading global indices, we are talking a lot about money flow. Okay, where the money is flowing, you want to follow that. Okay, but just do take note that short term here, when I'm talking about short term, is about 1 month into where we are from here. Okay, so somewhere around towards March, I think globally we're going to see a correction. Okay, so just be aware of it. Okay, why I say that is because of some of the other global macro environment that we talk about. Okay, of course, these are some of the charts here. This is from Zero Hedge. Okay, just wanted to show you this chart. Okay, over here, right? This chart here that says that basically the cash has been pumped into the financial market. Okay, so again, understand demand, right? We talk about this. Why I share about all these things is because these are the things that move the market. Okay, this chart here basically tells us that there is a drawdown in cash. Okay, and when there's a drawdown in cash, where does the money goes in? It goes into the financial market. Okay, and I want you to think that if all the cash has been put into the financial market, there's only one way it can go after that, out of it. Okay, because when you are invested in the market already and you start to see some profits, what will you do? You will take profit, right? You get out of it. Okay, so when that happens, that's where your market correction is going to come in. Okay, so when things are at extreme, you want to be cautious. Okay, and right now in the market, we are in an extreme. Okay, and that's why you're seeing so much of a correction happening recently. Okay, and it might already started. Okay, if you take a look at this here, where I have is basically just comparing how many percent of the stocks in the S&P is above its 200-day moving average. We are right now sitting at about 88%. Okay, which means almost all stocks are above its 200-day moving average. Okay, and if you just look at it, okay, if I just bring this out higher, right, on a weekly scale, okay, every time it crosses somewhere around the 80, okay, around this zone here, what happens? It comes back. Okay, every time it's somewhere at the bottom, what happens? It bounces up. Okay, so if you're already at the extreme zone, just now I mentioned, right, every time you're at extreme, be cautious. Don't be the last one to jump in and buy, and then while everyone is getting out. Okay, you do not want that, right? You do not want to be the last person to get involved and everyone is coming out and you be inside the empty room. Okay, so take note of that. Okay, as we are trading the indices, the equities market, I think just be cautious. Okay, be aware of a potential short-term correction happening. Okay, so from here, just to go back to the slides, where's my slide? Okay, you can download this entire slide deck and of course all the MT5 charting templates with the key zones and things like that. Okay, just head over to this website. Okay, and you'll be able to download. It's free anyway, right? Just put in your email so that I automate the whole process to automatically send to your email. Okay, so let me take a look at some questions. Okay, so right now, if you have, okay, I might overrun a little bit. Okay, but type in your questions. I'll do my very best to answer as many questions as I can. Okay, first off, we have question from Kong. Okay, or Wong. Okay, so Wong actually asks, what is the impact of the US stimulus which is expected this week? Okay, so over here, again, right, we talk about how cash is always in the increase, right? So the Fed is always printing money. Okay, that's a fact. Okay, so the idea here is that as money increase, stock market will rally. Okay, but nothing in the financial market is just go straight up. Okay, it's always going to be up and then some down as a correction and then move up again, right? So I would say that right now, in a big picture perspective, what the US has been doing is printing a lot of money, is supportive of the indices. Okay, it's supportive of the stock market. Okay, but just take note that if everyone has already bought in, naturally some people would want to take profit. Okay, so that's why we say we are expecting a correction, but we are not expecting a crash. Okay, I don't think a major crash is going to happen soon. Okay, but a correction is likely going to happen. Correction means people are taking partial profits. They are taking some, realizing some of their profits. They're exiting the market, and from there, of course, the market will drop a little bit. Okay, so I think overall, the whole stock market is still supportive of the upside. Okay, it's just that for the next maybe 1 month, be a little bit patient, wait for it to dip a little bit more, and then get in maybe at the low, right? So that's the idea of it. Yeah, so I hope I answered your question on that. Belinda has very specific stock that you're asking. I might not be able to answer you that because again, number one, I might not look into those stocks. Okay, I might not have the information. Okay, so I'm sorry that I'm not able to kind of give you a view on it, because if I'm not looking at it, I can't comment, right? I don't have sufficient data and information to share my view with you. Okay, Amit Tavar actually asked about, will Tesla do a rebound in the short term or will it keep sliding? Hey, very interesting. I'm not a Tesla fan. Okay, and again, what I realized is that people are either loving Tesla or hating Tesla, right? And with the recent news of Tesla buying about 1.5 billion worth of Bitcoin, honestly, I don't think that's a very smart move from a corporate point of view. Okay, but again, we are talking about Elon Musk. I don't think you want to buy into Tesla, or I don't think you want to look into Tesla right now. Okay, let me see if we can pull up a Tesla chart. Okay, I seldom look into individual stocks like that. Okay, but let's take a look at Tesla chart, right? Again, if you are from a technical point of view, right, I want to share with you that again, today we might not have the time to go into details, right? But the idea here is every time you see a push that is very strong, we call it an impulse move, right? Don't jump into a trade. Okay, and the only trade that give you a buy signal, okay, just now we talked about it, is this pattern. Okay, we talk about a crawl, a diagonal, right? Unless you see that, you don't buy. Okay, or if you see a flag, okay, then unless you see that, don't buy it. Okay, so that's the idea behind it. Okay, so right now the momentum for Tesla is definitely down. Why? Because Bitcoin dropped. Tesla bought so much of Bitcoin. Naturally, there's a correlation between these two pricing already. Okay, so that's why I say, if I am viewing it from a corporate point of view, I don't think it's a very smart move for Tesla to do that. But anyway, okay, that's the view that I have on Tesla. I think you do not want to get in buy right now. Yeah. Good. So Joe actually asked the DEX price to watch. You only mentioned key level. Okay. Have a losing short at 107.05. Again, I'm not in a position to advise Joe. I'm not in a position, or even any of you, right? I'm not in a position to advise you guys to trade. Okay. Again, to do that, you need to have a lot of risk management approach. You need to have a proper plan and strategy. Okay. But I think, okay, again, if why at the start I say that if you're looking at global indices, right, the path of least resistance is always up. Okay, so if you are looking to short indices like that, just be very, very cautious. Okay, it's a little bit more difficult compared to like buying it, because again, the path of least resistance is up. Okay, but if you shorted it at 107.5, oh, that is like way low. Again, I'm not in a position to kind of comment what you should do about your trade. Okay, but basically this black horizontal line is where you shorted. Honestly, okay, honestly, I would, if today you do not have a proper plan on this particular trade, of course the most logical decision is to cut it off. Okay, for the market to drop it back down to where you shorted, okay, you need kind of like a March 2020 event. Okay, I'm not saying that it's not going to happen, but again, as we are in this inflationary system, okay, the general direction is always up. Okay, so just take note of that. Okay, but of course, if let's say, for whatever reason, I don't know, okay, something bad, really terrible happen, if 1300 break, okay, you might want to keep an eye on this level here, which is around 11300. Okay, 11300. So whether is it going to go back to where you shorted it, very difficult to say, but you can see from where we are to reach there, you definitely need a scale like what happened in March 2020. Okay, so just my view on that. David asked, is there an impending market correction in the China stock market? I wouldn't say it's impending, I would say it started. Okay, look at this drop here. This is the daily, right? For the past 1 week, from this high, okay, let me use my pen tool, right? From this high to where it is right now, this is a very strong momentum drop. Okay, and I can tell you, yes, it might take a pause in a few days or even 1 or 2 weeks, but looking at how things go, I think it can easily drop back towards 10811. Okay, so of course, if you have your strategy, you have your risk management to short it, to profit from the drop, by all means. Okay, but again, you need to have a proper strategy and trade plan to execute it. Okay, over here, the simplest pattern for you is look for a flag, short it. Okay, so again, this is an impulse drop, so you have this portion here, just wait for this, and then you have that probability to sell it. All right. Ong has a question, which column in the COT represent the non-commercial? Okay, I don't really get it. Okay, but basically, okay, if you're going to the website and extract, you have 3 types of information, right? You have the commercial, non-commercial, and non-reportable. Okay, for large speculators, the big boys that we are talking about, they are your non-commercial. Okay, so just focus on the non-commercial data. Okay, so that's how you look at it. Sandy asked, when we rechart, what time frame interval should we look at? Sandy, just depends. This really depends on your type of trades that you want to take. Today, if you're looking at swing trading, you're definitely going to look at higher time frame, right? Something like 4-hour daily. If you're intraday trader, then maybe you'll be looking at like 1 hour, 30 minutes. Okay. If you are looking at global indices, which is the one that we're focusing on today, I will always suggest never go below 4 hour. Okay, because again, we are looking at big picture. We are looking at buying for today, right? Keeping it simple. The path of least resistance again is to the upside. You want to look at 4-hour daily on a bigger scale to see where you want to buy. Okay. Zheng Yu asks, is the US market at its peak and in a consolidation state, or is it potential? Okay, again, I won't be able to answer you like I have a crystal ball, okay? I don't, okay? So I won't be able to tell you exactly what is happening, okay? But I can tell you based on the data that we are looking at, there will be a correction, and I think it's happening right now. Whether this is gonna be the start of this correction down before the push to the upside, or are we gonna just, see that very, very minor dip and this just keep going? Honestly, I don't know, okay? But based on COT, we are seeing that the large speculators are looking to sell, okay? Based on the extremity of the analysis, right? We look at how many stocks are above the 200-day moving average in the S&P. Again, we are in an extreme zone, okay? So I would say that you can still look to buy, but just be cautious and be ready to cut your losses if, let's say, price really tank, okay? But go in small, okay? Go in small positions so that if it continue to rally, you won't miss out on it. But at the same time, if it start to really do kind of like a bigger correction, you won't get trapped too big a position into it, right? So this is something that you want to take note of, okay? David asks, with money moving out of US market now, is China benefiting from it? David, you got it wrong, okay? It's actually kind of like the opposite, okay? I would say that the money has already flowed into the China market, okay, or emerging market as well, okay? Money is already in there, okay, and that's the reason why you have seen emerging market rally, you have seen the China market rally, okay? I would say don't jump in now if you're not in the China market or the emerging market, because again, you do not want to be the last person to be going in when everyone is looking to get out, right? Don't do the exact opposite of what the majority of these big boys are doing. Okay, so I would say that moving forward, there's a higher chance of money flowing out of China and maybe coming back to the US. Okay, so be aware of that, which means what I'm seeing. Okay, just now we shared with you that chart, right? Let me just take a second and go back to that chart. Okay, we talk about this comparison, right? Where is it? Okay, this one here. Okay, we talk about how there is a potential that if this starts to go back up, this chart starts to go back up, that's where the money is going to flow back into the US. Okay, so take note of that. Okay, basically this is just comparing SPY and EM, which is your emerging markets ETF. Okay, take note of that. Okay, so last question by Jennifer is, what do you think of agriculture sector? Well, that's a very specific sector. Okay, now I would say you might not want to really put too much emphasis on agriculture itself. But if you ask me in terms of like where is the industry or the sector that has a high potential, definitely focus on AI. Okay, I think artificial intelligence is the next thing that's going to happen. Okay, and when we talk about AI, we are talking about things like self-driving vehicle. Okay, we are talking about like what Tesla is doing as well. Okay, EVs, those are all a bit towards like technology, a bit on artificial intelligence automation aspect, right? And maybe if I were to just share with you some specific companies that I'm personally looking, it will be Apple and Microsoft. Okay, personally, I think that Apple and Microsoft has a huge opportunity, and they have a lot of resources to really capitalize on the next trend. Okay, and if the next trend really is onto AI, these two companies has really huge potential to it, right? Apple, I think all of us know what they are. They are huge in cash, right? They can deploy that to do R&D and things like that. And of course, with Apple recent going into their vehicle space as well, right? Apple car, okay, when they launch it, it's going to be another big thing. Okay, so Apple is definitely one of the companies you want to keep an eye on. Why Microsoft is because Microsoft has been in the space of education, school, workspace, and of course all the software, all the computers we are using, majority of them are from Microsoft. Okay, so when artificial intelligence and automation trends kick off, again, the penetration rate of Microsoft is already there. Okay, very easy. They can utilize their resources and ride on that trend. Okay, and that's the reason why I say focus on these two companies. Okay, so that's something you want to keep an eye on, right? In terms of agriculture, I don't think I didn't really go into it, right? So there might be opportunity, but because I'm not in there, I can't share with you. Okay. So last question here by Joe. Please show the 2 slides of the 2 chart pattern that oh, okay. Okay, again, you can download all these slides, but this is the one over here. Okay, this is the first one. Okay, it looks like a flag. Okay, and the second one is this one. Okay, it looks like a diagonal, right, across. Okay, these are the 2 patterns. Okay, of course, the look of it might be different, right? So don't like say I want to look exactly like this. It's never going to be happening like that. It comes in various sizes or maybe slightly different, but generally the look of it is about there. Okay, something like this. Another question from Min. Could you please explain more about why we should look more at Hong Kong market? Okay. Now again, this is based on just technical. Okay, because Hong Kong HSI doesn't have the COT and things like that, right? So there are some limitation in the information from that point of view. Okay, but from a technical chart, you can see based on all the indices chart that I've shown you just now, right? Hong Kong is the clearest in terms of the pattern forming. Okay, so you get a very strong push up, you get a flat. Okay, so that's the reason why I say of all indices, Hong Kong is giving us the clearest sign to be looking for the upside. Okay, so because again, the bias here for today is I'm focusing only on buy opportunity, right? And right now, Hong Kong index is the only one that's presenting a very good buy opportunity. The rest of it, they are doing a major correction. Okay, that's the only reason. Okay, because I don't have COT data to back this up. Is purely from a technical point of view. Okay, of course, over here we can't see the previous high as well. Okay, so let me use borrow the platform on TradingView to share with you Hang Seng, right? Okay, HSI. So again, you can see this includes of course some of my analysis as well. Okay, I do a little bit of Elliott wave. Okay, so today we keep it very simple. Okay, so you take a look at where this chart, right? You can see this is the previous high. Okay, how price has moved off here. This is a very strong move. Okay, and we call this an impulse move. Basically, the momentum is to the upside, right? And you want to focus on the buy. Okay, so over here, of course, what we see, this is a weekly, right? So you can see very big. Okay, on a daily scale, this is doing a flag. Okay, if this is a flag, then you have the probability that this can continue up towards around 33476 area. Okay, this is the only, honestly, this is the only indices that I'm personally interested to buy into. Okay, for now, right now. Okay, the rest of the indices, I think they're all looking for a bigger major correction. Okay, so you might want to be patient on that if you're looking for it. Okay, cool. Okay, yeah. So I hope so far so good. Okay, again, I do my very best to answer as many questions as I can. Hope you guys actually benefited from it. Okay, I think that's the most important thing, right? At least learn or take away one thing from this webinar. Okay, for those of you who are very new, maybe it's a bit overwhelming. Okay, I can understand that. But of course, if you're very new, at least pick up one thing. Okay, that's like the most important part of it. Okay, so with that, I think okay, that's all that we have, right? So again, would like to thank Phillip Futures for having me, giving me this opportunity to share with you my experience, what I know. Okay, again, I don't proclaim that like I know it all, okay, but I'm just sharing with you here today based on what I know, based on my experience, and I really hope that that also benefit and help you in your whole trading process. Okay, so with that, I'm gonna pass the time back.
All right. Yep. Thank you very much for the insights, Yong, and thank you very much, everybody, for your time tuning into this webinar tonight. We will be sending everyone a link to today's webinar so you can watch it again if you'd like to. Do visit our website, phillipfutures.com.sg, if you'd like to reach out to us, or indicate in the post-webinar survey if you would like for us to reach out to you. That's all for today. Thank you, everyone, and goodbye.